One of the questions that I get from clients often when purchasing some type of insurance product, whether that's disability insurance or life insurance, is what happens if my insurer goes bankrupt? So maybe you purchase something from Sun Life, RBC, Equitable, Avari, any of these companies. What happens if that company goes bankrupt? Am I still covered? Is my family still covered? Do I still have my life insurance or disability? How does that work? And in this video, I'm going to explain the two different organizations that govern that and make sure that you're still protected as a consumer. And by the end of this video, you'll know exactly how this works and how you are protected. What is up, guys? For those of you new to the channel, my name is Philip Setter. I'm the founder and CEO of Affinity Life, where we've helped thousands of Canadians find the right life insurance at the right price, all from the comfort of their own home. If that sounds interesting, I'll put a link to book a one-on-one meeting with me in the description below, and you can check that out. But without further ado, let's get right into the video. Now, making sure that you're still covered in the event of a company going bankrupt, an insurance company going bankrupt, is a very legitimate thing to worry about, because maybe 15 years ago or 20 years ago, we would say that these companies are too big to fail. You've heard that expression before. You know, it's a massive bank, it's a massive insurance company. They're never going to fail. They're too big to fail. But 2008 really showed us that no, some companies absolutely can and will fail in the event of some type of big recession like 2008 or financial collapse. So yeah, at the end of the day, you want to make sure that if something like that happens again and you're invested in some type of insurance policy, maybe you have a big whole life policy or something like that. Maybe you just have term life insurance. Maybe you have disability life insurance. Maybe you have whatever type of product it is with an insurance company. Maybe you have segregated funds, which is a type of investment with an insurance related product, And so at the end of the day, you absolutely want to make sure that you're covered in the event of one of these companies going bankrupt, because 2008 showed us this can and will happen in the event of a global recession like that. So there's two different organizations, like I mentioned, that really help establish and govern if an insurer goes bankrupt and how that is going to be treated for you as the client. And so the first organization we're going to talk about is the OFSI. Now, what this stands for is the Office of the Superintendent of Financial Institutions. And all this is a government body that essentially stipulates regulations for all financial institutions, whether that's banks or insurance companies. Now, of course, there's a whole bunch of different regulations that insurance companies have to adhere to. However, the main one that is of concern to you is their capital requirements for liabilities. So what does that mean? Okay, well, if you take a life insurance policy out where maybe it's, $2 million or $3 million or $4 million of death benefit, they need to have the corresponding capital requirements just held in storage, in escrow, or not in escrow, but in storage. They have to have those requirements on hand in the event that you die, you pass away, and they need to pay out that claim. So they can't just leverage it like some banks you've seen do fractional banking where, they have $1 and they can lend $20. It's not that way with insurance companies. With insurance companies, if they have, let's say, $1 million of liabilities, assuming, let's say, $1 million death benefit that they have to pay out, then they're going to have a requirement of 120% on hand that they have to put there in order to have that death benefit available to be paid in the event that you pass away. Now, 120% is the minimum. However, the target is usually 150%. So if an insurance company has liabilities of, let's say, $10 billion on their balance sheet, that means that they're going to be required to have 15 billion, of capital that they can allocate if need be to whatever it is, death benefits or whatever those liabilities are. So this is a really important number to keep in consideration, because where banks, again, if you know anything about fractional reserve or fractional banking, they get $1 from you and they can lend that dollar out, 20, 30, 40 times. Their liabilities are quite massive, as opposed to insurance. Insurance is relatively safe with these regulations that are imposed by the OFSI, is that if you have a liability of $1, that means that you're required to have $1.20 and a target of $1.50 on hand should the needs arise to pay that liability. Now, some companies actually have really good capital reserves. Some companies might have as high as 200% or 220%. So these are some numbers you might want to look at when choosing an insurance company. However, at the end of the day, OFSI is really just there to create a regulatory framework that is going to help insurance companies not go bankrupt by not doing ill practices practices or leveraging themselves too much or having too many liabilities. But if an insurer does go bankrupt, OFSI has nothing to do with it. They're not going to bail you out. There's nothing there. There's another organization, which is what we're going to talk about next, which is Insurer, and this company will bail you out. Now, Insurer is a not-for-profit organization that essentially is like insurance for the insurance companies. And so all insurance companies, or I should say most insurance companies, pay in to be part of this organization known as Insurer. And in the event that one of the insurers do fail, this organization will take over all of the policies of that failing insurer, and it will insure up to a certain percentage when we're going to talk about this right now. Now, these numbers actually used to be quite a bit less, but in 2023, they're updated. I'm just going to read off my notes here. So in 2023, they actually upped a lot of the value. So you have now even more insurance through Insurer if your insurer does go bankrupt. So it's either going to be 90% of the value of whatever insurance you have, or the stated value below, whichever one is going to be higher. So let me explain what I mean by that, okay? So it's insured up to, for a death benefit, $1 million. For health expenses, so that could be health, prescription, dental, something like that, $250,000. Cash value and segregated funds. So if you had a whole life insurance policy that has cash value, or a universal life insurance policy that has cash value, or a segregated fund, which is like an investment with an insurance wrapper around it. And I have another video where I talked about segregated funds. Maybe I'll link it here. So if you're interested in that video, I'll put it right there. But that is going to be insured up to $100,000. So a little bit less. However, it's either going to be 90% or that amount. So let me explain what I mean by that, okay? So let's say we had a death benefit that was $750,000. And this insurance company went bankrupt. For whatever reason, they went out of business. Insurer is going to take over that contract, and the full amount of that would be covered, the $750,000, because you're insured up to the 1 million or 90%, whichever is higher. So 750,000, of course, you would get the full amount because that's less than 1 million. However, let's go through another example just so you kind of understand here. Let's say it was a $2 million death benefit, then only 90% would be covered because again, it's over that 1 million threshold. So 1.8 million, they would take over as the contract, and you would still have that in coverage. So at the end of the day, you're still going to be covered if one of the insurers does go bankrupt, and it is a very unlikely thing to happen. However, like I mentioned, as we've seen in 2008, just because it's too big doesn't mean it's going to fail. So there's really two different things you can do to try and mitigate some of these risks if this is still a going concern for you, even with Insurer and OFSI. The first one you can do is you can check the AM ratings. So AM ratings are essentially what the financial strength of that institution is. And you can look up the AM ratings for every single insurance company across Canada. If you just look up, maybe you're looking at Sun Life, you could go Sun Life AM rating, or Avari AM rating, or you could go whatever insurance company you're looking at, just, Google that with AM rating, and you'll see what the financial strength of that institution is. And it's governed by, B minus, B plus, A minus, A plus, A plus plus, et cetera, et cetera. That's the first thing you do. And the second thing you do, if it's still an ongoing concern and you have maybe a lot of coverage that you want to place, maybe $5 or $10 million or something like that, then you can spread out the risk between many different insurers. So instead of having it all at one insurer, just in case that goes bankrupt, maybe you could get 2 million at Sun Life, 2 million at RBC, 2 million at Canada Life, 2 million, at Avari, 2 million, et cetera, et cetera, et cetera. And you could spread it out between all these different insurers. So if one of them did go bankrupt, then you would still have the other ones. And of course, you would still have Insurer to cover that original one that went bankrupt. I hope that answered the question for you. What happens if my insurers go bankrupt? If you have any questions, just drop them in the comments below. And if you guys are enjoying this content, all I ask is that you give it a thumbs up, and I'll see you guys in the next one.